Good day, everyone. Welcome to today's session where we have the opportunity to meet Grace from Nikko Asset Management, who is the lead portfolio manager for the Nikko AM Shenton Emerging Enterprise Discovery Fund. So, stay tuned to hear more about Grace and the fund. First, let us begin with handing the stage to Grace for her to introduce herself and share more about the fund. So Grace, could you tell us more about the fund?
Hi Heather, thank you for the time today. So I'm the lead portfolio manager of the Nikko Asset Management Shenton Emerging Enterprise Fund. So it is a bottom-up fundamental analysis fund with our best small market capitalization ideas. So we define small market capitalization companies as those between $200 million to $5 billion in market capitalization, and they trade an average of $1 million over a 3 months range.
So as a small mid-cap fund, what are some of the unique advantages of investing in small and mid-cap?
So there are 3 main advantages of looking at small caps. So 1, they benefit from the information gap. 2, diversification, as well as 3, smaller companies are more flexible and adaptable to change. So firstly, in terms of benefiting from the information gap, so small caps are in general under-researched. So more than 50% of the stocks in our investable universe are actually covered by 5 or less sell-side analysts. And so this means that the stocks are highly likely to trade away from their intrinsic value. And we like to be positioned in these stocks in order to benefit from the upside when they trade closer to their intrinsic value and wait for the market to recognize them. So secondly, in terms of diversification, so zooming in onto small caps, the indices, when we invest in small caps, we can see diversification versus large caps. So the small cap index, which we identify as the MSCI Asia X Japan Small Cap Index, is more diversified versus the large cap index, which we refer to the MSCI Asia X Japan Index. As of September 2022, for example, there's more than 35% weighting in China for the large cap index. And this compares to slightly less than 10% in the small cap index. So we can see that the large cap benchmark is more skewed towards China. And in terms of sectors, the large cap benchmark also has more in financials. And the small cap benchmark, in contrast, has a more balanced composition. In addition, the top 10 stocks make up only 3.7% in the small cap index versus the top 10, which make up 26.2% in the large cap index. So do you know that Taiwan Semiconductor actually accounts for about 6.5% in the large cap benchmark?
Wow. Yeah.
And thirdly, so smaller companies are more flexible and adaptable to change. So the operating environment we think is changing today, and in particular, given today's environment which big tech is under scrutiny, smaller companies will find themselves on a more even level playing field with large caps. And this also means that they have an upper hand as they're not restricted by legacy statements, by legacy systems or old technology. And it also means that they can exploit smart tech and deliver more innovative products and solutions to their clients. So while incurring lower costs, so we think that smaller companies are well positioned given their size as well as their flexibility.
Right. So you got that, guys, that there are many advantages to investing in smaller companies. So the next question that I have for you, Grace, is how has the fund performance been and what actually drove that performance?
Okay, so as of 30th September, so the 3-year performance of the fund is about 18.86%. outperforming the benchmark, which is the MSCI Asia X Japan Small Cap, by about 10%. And over a 5-year period, the fund did 11.72%, outperforming the benchmark by approximately 9%. So some of the outperformers in our fund include Hyundai Bioland, which is a raw material manufacturer based in South Korea. It manufactures cosmetics as well as food raw material products. So this company did pretty well for us. Myeongshin Industrial is also another company that we like that did well for us. So it's an auto parts manufacturer that supplies to Tesla as well.
Understand. Right. Wow. That's a really outstanding performance, Grace. So maybe you could tell us your secret. Could you help us look at how you actually look at investments and maybe what's your investment philosophy?
Okay, so our investment philosophy is centered on 2 main areas. So we look at stocks that can deliver sustainable returns and/or positive fundamental change. So sustainable returns would refer to factors like companies with high ROE, so high returns on equities, which is a measure of net income divided by shareholder equity, as well as consistent earnings growth. In terms of positive fundamental change, it could be things like new management with a strong track record, or change of strategy or policy change. So those are kind of things that we look at as well. We also overlay that with an ESG lens. I think that's especially important in smaller companies because a lot of them don't have ESG ratings on public sources. So a lot of the analysts have to do analysis themselves and engagements. And I think particularly in Asia, due to the diverse markets, we think that focusing on these areas are key to delivering excess returns above the benchmark.
Right, got it. So earlier on you mentioned a few of the stocks that are in your portfolio. So maybe could I ask what are some of the stocks that you have in your portfolio and what are the investment keys for them?
Yeah, so CTCI is one company that we like. So it is a $1.1 billion market cap company. It is the number one engineering, procurement and construction company in Taiwan. And it is one of our uncovered gems, which only has 3 sell-side analysts covering it. So there are 3 main reasons why we like the company. So firstly, it's a beneficiary of the growing ESG trend. The core business, I think, historically has been refining and petrochemical. Areas we know are not really carbon friendly, right? So the company was pretty quick to identify ESG as a growing trend, and it successfully pivoted its business to focus on green-related projects, so showing positive fundamental change. And with the increasing focus on carbon neutrality, there also needs to convert existing facilities or factories to reduce carbon emissions or build new factories that are carbon friendly. So more than 70% of their order book is actually related to green projects. And when we compare that to the Korean kind of EPC companies, less than 15% of their order book is green projects. So this is a good example, I think, of flexibility of smaller companies being able to pivot towards change. Secondly, they are also a reopening beneficiary. So as a lot of delayed projects, I think because of the COVID pandemic, they got delayed, and now we are finally seeing them getting restarted, and there are new contracts being signed as well. So raw material prices have been rising, and the company, I think, couldn't properly reflect that, and margins were hit. But as the old contracts are being phased out and new contracts are being signed, I think they'll be able to pass on the higher raw material costs, and we should see margin recovery as well. And lastly, strong balance sheet. So this company is in a net cash position, and they also have double-digit return on equities. And in terms of ESG, so they've been awarded the top 5% listed companies in the corporate governance evaluation by the Taiwan Stock Exchange. And they've also accumulated electricity savings of 900 gigawatt hours of green engineering from 2018 to 2020. And on the social front, I think they focus on total safety. So they focus on employee health as well as well-being. So those are important factors as well. So we think that both growth and ROE should improve from current levels. And it trades at about 11.7 times price to earnings for FY23, with 10% forecasted growth in earnings and 4.9% dividend yield. So we like the stock. And in terms of risk, I think the risk would be delayed in projects, as well as higher raw material prices are the main kind of factors for the company.
Wow, an interesting company with good growth drivers and also attractive dividend yield.
Right.
Yeah, so maybe we shift gears a bit. I wanted to also hear more about your macro outlook, about whether there are certain tailwinds and headwinds on your portfolio.
So our portfolio is bottom-up focused. So the country and sector weights are a function of where we find the best ideas and strongest conviction rather than our macro views. Headwinds such as higher interest rates, energy prices, as well as the lack of workers are mainly priced in, but have less of an impact in Asia. The biggest issue of the lack of workers, but Asia, I think, has abundance of workers coupled with current account surpluses. So Asia is in a relatively stronger position, and reopening in China is also an upcoming catalyst, and long-term growth will be driven by consumption. So these are key areas to watch. China reopening would also be positive for our portfolio, and we are positioned accordingly. China equities are also at a very low valuation, so we remain constructive there as well.
Got it. So maybe you could also add on and elaborate a bit more on how you are positioning in this environment.
So I think coming back to our philosophy in terms of looking at stocks with sustainable returns and or positive fundamental change. So we look for stocks in this bucket, and we prefer higher ROE stocks. So as of 30th September 2022, so we have an average ROE of about 19%, and that compares to our benchmark of 5.7%. So we also prefer quality stocks that are in a net cash position. So we think that's especially important because they'll be able to weather the downturn. And more than half the stocks in our portfolio are actually in net cash position. So this is pretty important given today's rising interest rate environment as well. So we know the companies will be able to survive and emerge stronger.
And I also saw something interesting about your fund is that it has a overweight in consumer discretionary and underweight in IT, and this is relative to the benchmark. So what do you like about consumer discretionary and not like about IT?
So our sector and country weights are a function of where we find the best ideas. So in this case, I think we do find better ideas in the consumption and the consumer sector. So that has led to the overweight. I think Asia has a strong consumption story that we like. And some of the sub-sectors that we like include like hotels as well as fashion retailers, which also benefit from reopening as well. Conversely, we don't find enough ideas in the information technology area, and as a result, we're underweight. Some of the IT names we do like include a diversified high-mix, low-volume cable assembly maker, which focuses on 5 main segments: green energy, industrial, automotive, communication, as well as medical.
Got it, right. And you mentioned a bit earlier about ESG investing, so I was hoping we could jump into that about how you look at ESG investing, how is it incorporated into your investment process, and maybe if you could share with us a case study.
Right, so ESG is integrated into our stock picking process. So we have an internal scorecard, and we are required to score ESG, the impact on sustainable returns and fundamental change. So ESG is not something that we feel compelled to do just because it's the latest trend, but we do believe in it from two perspectives, so risk management as well as opportunity. So we believe that it has to be integrated as part of our process, not something tacked to at the end. So we identify opportunities and the risks, and we identify whether they can be mitigated through our engagement with management. We then build this into our proprietary risk metrics, highlighting areas of focus from a materiality perspective. So while there's a misconception that smaller companies don't engage in ESG, so we find it rather the contrary. There are smaller companies that care about ESG. So DreamTech, for example, is a Korean IT company that we like, and it has a market cap of $480 million. So it started out as a component manufacturer for phone parts and has now extended its business into new business units such as medical, where they produce electrocardio wireless patches for measuring the heart rhythm, as well as orthopedic parts. So it is a company that we've been following since they listed in 2019. And with time, we've seen the ESG of the company improving. So they've separated the CEO and chairman role as well to increase professionalism. And in 2020, they've appointed a co-CEO. So now they have two CEOs. So Mr. Kim for the healthcare side and Mr. Park for the handset side as well. And they also have an employee stock option program as well. And they pay a dividend. 1/3 of their board is also independent. So on the environmental front, they focus on sustainable production and they have clear targets in terms of power consumption. And on the social front, they have engaged actively in corporate social responsibility as well. So while they haven't published an ESG report yet, so the company is actively working on it, and there's no sell-side coverage as well. So a lot of engagement is done by us internally, and I think that's where we can benefit from the information gap mentioned earlier, as these stocks are relatively under the radar.
Right, got it. Wow, many interesting things about DreamTech, but maybe I just wanted to ask one thing about something you mentioned about DreamTech, of how do they actually, could you elaborate or give us an example of how do they actually achieve that sustainable production and have that target for power consumption?
Right, so the company targets to reduce power consumption by 5% this year. And they've also obtained the ISO 14001, which is an environmental management certificate in 2004 actually. So the certificate basically specifies the requirement for environment management that is an organization that organizations can use to enhance their environmental performances. So it's intended to use by the organization to manage its environmental responsibilities and in a manner that contributes to the environmental pillar of sustainability.
Right, got it. Wow, really interesting. Thanks so much, Grace. So just to wrap up, could you just share with us something more on a personal note of what do you enjoy most as a portfolio manager?
I think the best part about being a portfolio manager is learning new things, discovering new stocks, and also watching them grow from tiny little acorns into big oak trees. So I love meeting companies and learning more about their businesses. And I think as stewards of capital, we do have the ability to allocate capital into areas with the most growth potential. And at the same time, we can help investors grow their wealth as well. So that to me, I think is the best position to be in.
Right, got it, Grace. So that's all we have today. Thank you, Grace, for joining us, and thank you all for watching.